friends. Today we'll be discussing on a very important and a timely topic that should thoughtful investors participate in IPOs. In the recent past, we have seen that a lot of IPOs have kind of done well, and the experience of an investor, if you had invested in an IPO in the past 1 year, maybe a slightly longer term, has been a bit better. But and also, SEBI published a very insightful piece on the whole IPO fancy that has taken a lot of investors. Uh, According to them, there is a clearly a flipping behavior on part of investors. People are not holding more than a week. According to the data, more than 50% of the people kind of move out of a position within a week, and when you annualize that number is upwards of 70%. So these sort of investors are clearly chasing the listing gains, which may or may not come. In a bull market, you would have listing gains, but when the cycle turns, chances are the listing gains may not come. But from a investor perspective, it is important to see how these IPO companies have fared over a very long period of time. That means upwards of 3 years, 5 years, and even long term. So if we clearly see uh, the data, this data goes back to pre-GFC crisis, 2007. So we have analyzed a lot of IPOs that have come in from that period in the main indices. Data does not include the SME index. But if you see, out of 389 companies that got listed since 2007, 51% of them have underperformed a frontline index such as BSE 30 over a one period of since one period of the listing. And if you see 3 year and 5 year, the number increases. It is almost 69% of the companies which fail to beat the index over a 3 year, since listing. And that number is close to 70% when you look 5 year horizon. So clearly, from a long-term perspective, IPO investing has not really rewarded, investors. And there are various studies that have been done. Professor J. Ritter, who has done this analysis going back to several decades in US markets, has also found that over a period of time, uh, since the IPO prices, they have failed to beat the relevant benchmark over a very long period of time. What could be the possible reasons? One reason is very clear that you find many IPOs that are coming into the market, wherein a promoter or a founder, or now it could be sometimes private equity firms, are trying to maximize their own gains. So they would try to get the best possible rate that they could. And this data kind of tells you that if you look at the data of the companies being listed and what multiples are they trading at, you know, almost 107 of those companies are trading at upwards of 50 times multiple. And this is what have they been trading at during a certain period, but at listing, this ratio would be even higher. So that tells you that the offer for sale portion, or where the founders or the PE are selling out their stake, clearly they're doing it at an exorbitant price, which may not be in the interest of a investor like us. The other is, of course, if you see the number of IPOs also get bunched up, right? So after the bull cycle, pre-GFC, we have seen in 2007 there were the record number of IPOs, because it comes on the backdrop of very strong years for equity markets. And the situation is no different now also, that when the market does well, chances are the most number of IPOs would come in the bull phase of the market. And if you are invested on those highs, the chances of you making money going ahead significantly reduces. There is a comment which our founder, Mr. Ajit Dayal, has said that typically in an IPO, he likens IPO to a beauty parade, wherein the investment banker who offers the company sales, who offers the company the highest price, generally wins the mandate. So it is not clearly in the interest of a minority shareholder or retail investor that those companies are really thinking about. So, in such an environment, clearly, what should an investor do? And to start off with, what is the quantum philosophy with respect to IPOs? So, at Quantum Long Term Equity Fund, Tax Saving Fund, even other funds, so we do not participate in IPOs at all because we think because of two, three conditions. Number one is like we really want to get into a liquid name. And at the time of at the IPOs, generally that liquidity is not really settled. So we want to get into a company which is fairly liquid for our portfolios. The other is we also want to see the management over a period of time. We want to look at normalized earnings. Generally what we have seen is many of the companies just prior to IPO or near IPO, the numbers are kind of massaged in a way that either it's at the peak of the sector cycle, or the numbers are kind of better leading in the years leading up to the IPO. So we generally want to look at a company or judge it on a normalized basis, which comes over a period of time. So we have at Quantum has stayed away from investing in IPOs, and the advice is the same for any other investor who are either unit holder or looking at. So some of the conditions that we should really know is when investing in IPO, the odds are heavily stacked against an investor who is into investing into an IPO for the reasons that I said, right? Number two, we have to look at a normalized profit cycle, which could run, 3, 4 years of profitability analysis, how the company has done. So we cannot just accord a value, basis what it has done in the last year. And generally, the last year tends to be pretty good, leading up to the IPO. Lastly, we should not overpay. We have to look at each of these companies which are coming through for an IPO with respect to its broader sector, how the what is the base rate in terms of how other companies have performed. So if we follow some of these principles and remember that in an IPO the chances of a person making money is outside of the listing gains, which could be volatile, the history suggests that the odds are heavily stacked against an investor to make money. There are few IPOs in the past which have done extremely well, but they are you can't count them on them. You can count them in their numbers. On it's very few and far in between. So happy investing, friends. Thank you for joining us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.